What's the impact of the Supreme Court moving to strike down the bulk of these tariffs now?
I think investors are, one, generally relieved. I know it adds some uncertainty, but I think that they might actually also breathe a sigh of relief that it's kind of putting limits on executive powers. I also think stocks are going to start to be bifurcated on what stocks are sort of unaffected by these tariffs versus those that have some either positive but uncertain timing of when that happens. I kind of think this is going to help revive the technology, software, and even the crypto trade, because those groups have been largely shielded from the original tariff impacts, and they're not going to have any clouds of them over the unwind or the Supreme Court ruling.
In a 6-3 ruling, the United States Supreme Court determined that President Donald Trump did not have the legal authority to impose his sweeping Liberation Day tariffs announced on April 2nd.
Here, the Supreme Court ruling that President Trump's use of these emergency tariffs that he has implemented are illegal. It's the most significant economic case to reach the high court in years, sweeping implications for the economy and, of course, for presidential power. And at stake here are billions of dollars in revenue that have already been collected by the government. Pamela Wolf, the other significance here is that this is the first time that the 6-3 conservative court has ruled against President Trump in one of these major cases that have gone before the court since he returned to power in January.
At the center of the case was the administration's reliance on the International Emergency Economic Powers Act, commonly known as IEEPA, a law historically reserved for addressing genuine national emergencies. The court concluded that this statute could not be used to justify broad tariff measures. In its opinion, the court emphasized that the Constitution assigns Congress the exclusive authority to levy taxes, a category that includes tariffs. The ruling does not merely reshape trade policy. It introduces fresh questions about inflation pressures, government revenues, and the broader direction of financial markets. To help interpret the implications of this ruling, we turn to two well-known voices in finance. Tom Lee, co-founder of Fundstrat Global Advisors, sees the Supreme Court decision as a relief for markets that have been wrestling with uncertainty over trade costs and inflation. He argues that removing the threat of broad tariffs could ease price pressures, strengthen confidence in key technology and growth sectors, and potentially support a more accommodative monetary policy. All factors that, in his view, may benefit not only equities, but also risk-oriented assets such as cryptocurrencies. Cathie Wood, CEO of ARK Invest, echoes some of that optimism, but from a slightly different angle. She describes tariffs as a form of tax on growth and suggests that eliminating them should reduce costs for businesses and consumers alike. Wood also highlights how this change may improve prospects for innovation-oriented investments while softening inflation measures that have weighed on markets. Both see the ruling as a catalyst that could ease inflation dynamics and encourage investors to revisit assets that suffered under the weight of tariff-driven uncertainty, particularly cryptocurrencies like Bitcoin, Ethereum, and others. If you're trying to understand what this decision really means, not just for crypto, but for the entire risk landscape, please watch this video to the end, like this video, and subscribe to the channel for more videos. Your support helps with the YouTube algorithm and contributes to the channel's growth. Thanks, and enjoy the video.
Energy and basic materials have been our top sector pick for this year, and we like industrials. And, there's so many good fundamental reasons to sort of favor, as you've been calling, like real-world companies. And I think that there is still a lot of legs to that because we know that there is an investment spending cycle coming. But I also think we're kind of in the later stages of that decline for software, which has really had a waterfall decline, and for the Mag 7, which are seen as the armies of the AI trade, not the bullet makers. So I think that that's going to provide a lot of support for the overall index, because if Mag 7 and the software stocks stabilize, it allows the market to trade higher.
And I'm curious how important it is to the markets, to everything we're talking about, that they continue to lower rates.
I think it's a big deal because, as you point out, from 2022 to last year, the Fed is trying to establish inflation credibility and fight inflation. So even as they cut rates, it's really been a hawkish Fed. Now that I think tariffs could reduce headline inflation and goods inflation, and we have a job market that is kind of softening and inflation cooling, I think it does allow a dovish Fed to happen. And I think with the Supreme Court ruling, it may even be a Fed that actually has a better ability to cut rates. So I think it would be positive.
Yeah. Do you think they're doing the president a favor in a weird way?
Yes, again, I'm not a policy expert, but I think as you think about midterms and the idea that there is some potential price relief coming, it might actually be helpful for the administration.
Tom Lee's argument ultimately centers on a simple but powerful chain reaction. If tariffs fade as an inflation driver, then headline inflation may soften further, which in turn expands the Federal Reserve's flexibility. In that framework, stabilizing software and mega-cap technology stocks are not merely sector stories. They become potential anchors for the broader index, allowing risk appetite to rebuild rather than contract. Cathie Wood approaches the same development from a different angle, but arrives at a strikingly similar conclusion. Where Lee emphasizes market structure and sector dynamics, Wood frames tariffs more directly as a tax on growth, arguing that their removal could relieve pressure on both consumers and companies while reshaping expectations for inflation, rates, and economic momentum.
The Supreme Court just struck down Trump's tariffs. The ruling passed 6-3, so not even close, actually. And there are a couple of things we're taking away from this. Number one, what the Supreme Court is saying is President Trump has to go through Congress in order to put tariffs or other tax increases in place. And as you know, we've called tariffs tax increases. I don't like tax increases. Most people don't like tax increases. So you'll notice that the equity markets are up today, and the bond market is not selling off that much. So this was getting into the market. I think there was there were a lot of people suggesting that the Supreme Court would do just this. Now, of course, President Trump has come out and said, okay, fine, 10% tariff across the board then. And again, that will probably have to go back to the Supreme Court. I think that Trump doesn't want to lose negotiating leverage with the rest of the world. But there's something else going on. If you've noticed what he's been doing in recent weeks in response to the affordability crisis, is he has been taking tariffs off of categories like beef and coffee and furniture and necessities. So that's very interesting. He also wants to see inflation, headline inflation, going down. And so I think that this 10% tariff talk is just that. He doesn't want to lose leverage in negotiating with other countries. And if you think about it, he has been getting some very significant deals having to do with foreign direct investment in the United States to restore our manufacturing base. And of course, a lot of that is around technology and the new tax law, which accelerates depreciation dramatically. So we do think the return on invested capital in the United States is going to go up because of deregulation and tax cuts. And we're going to have a lot of foreign direct investment. Now, one of the characterizations of trade deficits, which President Trump believes are disastrous, is that the rest of the world is really taking business from the United States because of unfair trade practices. And he has been using this negotiating leverage around tariffs to create a more even playing field. I don't know how much leverage he's lost here, but if you look at the last year of the trade deficit, it has not gotten better because of tariffs. In fact, if you measure it in terms of goods, it's gotten worse. As many of you know, our position on trade deficits is different from that of President Trump, because the other side of a trade deficit is a capital surplus. And a capital surplus, we think, that is going to go up because of foreign direct investment, because of our new tax rules. Now, algorithms in the market, and when there's fast breaking news, it is the algorithms and high frequency traders that take advantage of the breaking news. I think the first response was, to take the market down from what was a very nice up day to something lower, not lower on the day, but just taking some of the gains away. But now the markets, the equity market's coming back. The bond market sold off, but it too is coming back. And the yield curve, interestingly, has flattened a bit as long rates have not reacted the way that people expected them to, meaning go up a lot. So I think the markets are treating this with a bit of a yawn. I will say that the more innovation-oriented growth portfolios, especially aggressive growth portfolios, are having a bit of a setback. One of the reasons is defense tech. I think that a lot of people feel that the defense sector will be hurt because we're going to have less revenue coming in from tariffs to spend on defense. And I just think that is, I don't think that's going to happen. I think defense spending is going to continue apace, if not accelerate. So that's when algorithms are taking over, when something like defense tech responds to this piece of news. One other thing I'll just note, since the numbers were out today, real GDP growth was surprisingly low. At one point, I think the Atlanta Fed estimated that real GDP growth in the fourth quarter would be 5.3%. It came out today at 1.4%. And what happened? Well, the trade numbers were revised down, in other words, into more of a deficit. So you can see even recently, the tariffs haven't helped our trade deficit. There also was the government shutdown. And so we do think there were a lot of distortions in that number. And if anything, with tariffs coming down, if they are tax increases, and tax increases hurt growth, we believe, the opposite should be true now that they have been struck down. This should actually accelerate growth. A tax cut encourages more growth. And it also will take some upward pressure away from our inflation statistics. So the trueflation number, as we've been saying for quite some time, is lower than 1% now, having peaked at 12% at the peak of the COVID crisis. These are 10,000 consumer prices monitored 24/7 continuously. So those pressures had already started coming off the inflation rate before this tariff announcement. So they could get us, the tariffs coming down, actually could get us closer to zero or negative during the next 3 to 6 months. We shall see. So we're not worried about what's happened in a way, as I've described. It is a positive. I think we've been pretty consistent saying tariffs are a tax, taxes are negative for growth. We take them off, and I think we'll probably see more growth this year than we otherwise would have.
In a swift response, President Trump announced a new 10% global tariff under Section 122, applying it over and above existing trade measures.
So we can use other of the statutes, other of the tariff authorities, which have also been confirmed and are fully allowed. Therefore, effective immediately, all national security tariffs under Section 232 and existing Section 301 tariffs, they're existing, they're there, remain in place, fully in place, and in full force and effect. Today, I will sign an order to impose a 10% global tariff under Section 122 over and above our normal tariffs already being charged. And we're also initiating several Section 301 and other investigations to protect our country from unfair trading practices of other countries and companies.
The announcement immediately reintroduced an element of uncertainty that markets had only just begun to process. What initially appeared to be a clear turning point for trade policy quickly evolved into a reminder that tariff policy remains very much alive, only now operating under different legal pathways. At the same time, attention has shifted toward the financial consequences of the ruling itself. Importers have already paid an estimated $150 billion under the now invalidated tariffs, raising the possibility of significant refund claims. These repayments would not occur automatically. Companies may need to pursue legal or administrative channels to recover those funds. If large-scale refunds materialize, the government could face a notable revenue gap, adding pressure to borrowing needs at a time when deficits are already closely monitored. This creates a more complex picture than the initial market optimism might suggest. On one side, lower tariffs could reduce cost pressures, gradually easing inflation and strengthening the case for interest rate cuts. Lower inflation combined with easier monetary policy has historically supported risk assets, encouraged capital flows into growth-oriented sectors, and improved sentiment across equities and digital assets alike. On the other side, refund obligations and lost tariff revenues could increase fiscal strain, potentially requiring higher government borrowing. Rising borrowing needs often place upward pressure on Treasury yields, which can tighten financial conditions even as the Federal Reserve moves toward easing. Markets, in other words, may find themselves balancing two competing forces, improving inflation dynamics alongside growing concerns about debt and funding costs. The crypto market's reaction was immediate, but far from decisive. Following the Supreme Court's ruling, Bitcoin briefly surged by roughly 2%, pushing above the $68,000 level. The move, however, proved short-lived. Within minutes, those gains faded, with BTC sliding back toward the $67,000 range. The reversal came against a backdrop of mixed economic signals, as fresh U.S. data pointed to slower-than-expected growth alongside inflation readings that remained stubbornly elevated. This type of price behavior has become increasingly familiar in crypto markets. Sharp reactions to headline news are often followed by equally rapid reversals, suggesting a market that remains highly reactive yet hesitant to establish sustained directional momentum. The contrast with equities was notable. While Bitcoin's rally faded quickly, stocks, particularly the Nasdaq, showed greater stability, maintaining their upward move through the session. Historically, Bitcoin and technology stocks have exhibited strong correlation, often rising and falling together as expressions of broader risk appetite. The recent divergence, therefore, stands out. Equities have demonstrated a greater ability to absorb macroeconomic uncertainty, while crypto continues to struggle with follow-through, even when news appears supportive. Rather than pointing to a single explanation, this divergence highlights the complexity of current market conditions. Liquidity dynamics, positioning, and investor sentiment all play a role in shaping short-term price movements. In that context, Bitcoin's fleeting rally may say less about the ruling itself and more about a market still searching for conviction. Even so, longer-term interpretations remain more constructive. Tom Lee's broader argument suggests that easing inflation pressures, combined with the possibility of more accommodative monetary policy, could gradually improve the backdrop for risk-sensitive assets. If those conditions begin to stabilize, episodes like this, brief, reactive, but directionally positive, may ultimately represent early signs of a market attempting to regain strength. For crypto investors in particular, this moment underscores a familiar reality. Price moves may be swift, narratives may shift overnight, but the forces that ultimately drive sustained trends, liquidity, policy direction, and macroeconomic stability, take far longer to play out. The real question now is not whether this ruling mattered, but how markets will digest the chain reaction it has set in motion. If you found this analysis valuable, make sure you subscribe and let me know your view in the comments. Does this ruling strengthen the case for risk assets or simply introduce a new layer of uncertainty?